Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also with Commodity Research Group, and we're here with another edition of Energy Markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and our blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. You're not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is December 2nd. Good morning, Andy.
Good morning, Jim.
We have an OPEC meeting staring us in the face, December 5th. What do you think?
Well, it should be an interesting meeting. There's a lot for the OPEC ministers to discuss. You know, they're going to go over the fundamentals, and we will too, actually. And there's going to be a lot of talk about condensates. I can't remember an OPEC meeting where the headline, one of the headline news has been condensates. For our listeners, condensates are light crude, very light crude, and condensates can be used to run through certain refineries to make refined products or petrochemicals. It is crude-like and is not included in most of the OPEC quota numbers or target numbers. However, it is included in the Russian numbers, and the Russians are beginning to balk at that inclusion, Jim.
So that's that. How much? Do you know how much Russia? How much barrels a day this you're talking about? Is this significant?
It is significant because their condensates are probably 500 to 600, 600 a day production. I think they're really looking at about 200,000 or 300,000 barrels a day on this quota deal. Maybe more than that. But you know what, Jim? The Russians are right, because as I said, the other OPEC producers don't have condensates. They're in a line called OPEC NGLs and other OPEC, and they're not crude. So this number is pretty significant, because the Saudis have come into this meeting hoping to have an agreement to either reduce production by 400,000 barrels a day is the number that's being floated, and to get the Russians to continue to continue to comply with their number, and the Russians don't want to do it. You know, they'll comply with their crude number,
right?
But I don't think they'll comply with their crude plus condensates number.
So they're over good. Now, correct?
They're over. They're not. You know, they've complied like 3 months out of the year when their pipeline went down. You remember when they had a pipeline issue earlier in the year? So they have complied 3 months. They're probably 100,000 over their number, maybe more. And
so, the other alternative is no cut and extend. I mean, this agreement goes out to March. Is that correct?
Yeah.
The way it is now, and so they could not cut anything and extend it. That's another possibility.
Yeah, I think that's definitely another part. You know, first of all, who's going to cut is always a big question on this. When ministers get together, the Saudis have been shouldering, more than their share on production. You know, they've been well under what their target is, which is around 10.3, and they've been 9.8, 9.9. You know, so they've definitely been they've been taking the lion's share of the OPEC cuts, and of course they also we're fortunate that Venezuela and Iran's production have basically collapsed over the last 2 years, as we've discussed. So that's helped the OPEC ministers as well. They're going to ask Iraq, who's probably like 50 to 100 over where they should be, to cut, and they're going to ask Nigeria to cut. Maybe they can get 50 out of each, maybe. So there's 100. And, the Russians, I don't think the Russians are going to cut anything. I think they're going to try to finesse this condensate issue.
Yeah, they'll just redefine it.
Yeah, just redefine it.
So
as a result, you're going to get more production out of Russia, not less. I think, going forward.
So, Andy, what do you see in a couple of days as the outcome of this OPEC meeting?
I think that they are going to be able to affect some modest cut, maybe like 200 to 400. I'm not sure where the Russians are going to come in. Maybe they'll do something, try to finesse the whole condensate issue. Extend the cuts till June and get out of there. And I think that would be it'll be either unchange or a modest cut, and then they can get out of there. And the market's going to be, the market's not going to like it, but the issue, Jim, is that the first half is going to be problematic for the ministers. They know it. The market knows it. The demand for their crude is probably between 750 and 1 million barrels a day below what they're going to produce. So, unless they're going to cut 1 million barrels a day, we're looking at a surplus in the first half. And second, if they can get through the first half, the second half looks a heck of a lot better. Second half looks balanced to a draw. So, the real issue here is trying to get through the first half of 2020.
So when you talk about part of the issue is non-OPEC supply. So let's just talk about that for a second. We have it looks like somewhat of a surge of maybe 2.5 million barrels a day of non-OPEC supply coming on.
Right. The IEA has around the big three. Most of them are over 2 million barrels a day. And this year or next year, 2020, it's not going to be so much from the U.S. and we'll certainly talk about that in detail. But we've got new supply coming from Norway and Brazil. These were as a result of long-planned offshore fields, and we'll also probably see more barrels. We'll see barrels coming out of Guyana, where Exxon has made a big investment that's going to pay off in 2020. Guyana is going to go from like zero to over 100,000 barrels a day, and Exxon is talking about that Guyanan production ultimately being 750,000 barrels a day, during the 20s. So, this is all, Brazil's numbers actually, Jim, beginning to come through.
Yeah, we talked about that.
We talked about that. It took a while, but they're they're finally beginning to come through. And, Norway is definitely, that's happening.
Yeah, so, I kind of thought Norway was getting out of the oil business, but they're ramping up in the North Sea.
Right, they're ramping up. They had a major discovery. These are projects that have been long planned, and they're finally coming to fruition. So the first half of the year, we're going to see a pretty big increase. And then we've got the U.S. because we're going to increase production too, but not quite as rapid a pace as we did in 2018 and 2019.
So let's talk about those U.S. numbers for a minute. I mean, there was kind of the big increase in the U.S. happened in the last 4 or 5 months.
Yeah, since January. I think the January number was the January U.S. crude production in January was something like, let me get this, it was 11.86. And we're now at 12.9. So we've already gone up 1 million barrels a day this year. And and that's just crude. That's not. And NGLs too have exploded as a result. So total liquids are way up in 2019. For 2020, though, if you take right now, we're at 12.9 million barrels a day of crude. The EIA is saying we're going to go, 13.1. They think December is going to be pretty high. I don't know about that, but their December number is 13.1. So they think there's another 200,000 a day to go in December. But then next year, they've got first quarter at about 13.2 and second quarter at 13.3, and then plateauing at 13.3. So we're not going to see, everyone's throwing out, oh yeah, U.S. production. Not everyone, but if you look at the year to year, it's over 1 million, but the year to year includes the low numbers from the first quarter of 2019. If you go from right today, the numbers are gonna stall. And some people, there's some estimates that have us growing only 400 year to year, which would basically be a decline.
Right. You don't see that though.
No, I really don't see that.
So part of this is due to new pipeline capacity getting out of the getting oil out of the Permian area?
Yeah, definitely. The differentials have narrowed in, and now you can get crude to market, and you'll be able to continue to get crude to market through through probably through most of 2020. Things look pretty balanced, to maybe even a slight overcapacity on pipeline. So the other thing that's facing OPEC, Jim, talking about U.S. producers, is if the price goes too high, that's going to bring on more supply.
Right.
Particularly in the if the back of the curve, of 2020, second half 2020 or 2021 starts really, rallying sharply, we're definitely going to see more hedging, right?
Right.
And that, that's going to bring more barrels. I mean, some people say, oh, it's the end of the Permian. I don't, it's definitely not the end of the Permian, because you've got, you got Exxon and Chevron in there, and Oxy's got to pay for Anadarko. They're in there too.
Yeah, I think it's always been when you think about oil coming to market, it's always been a function of price, and it's amazing how much oil you find when prices are at 100 and how much you cut back using it, and then down around what do we get down to $29 on the decline? How oil production it stops or goes down. I think we probably won't run out of oil. It's just a question of how much at what price, and how much.
Right.
So.
Yeah, but the majors obviously have a much deeper access to capital, and they're going to keep. They'll probably just keep drilling. I think what we're going to see is those smaller independents are going to have to merge or just go out of business. And I think that's what we'll start seeing in 20 and 21. And if prices remain in the 50s, we'll probably see some larger players continue to be in there.
So you said that in the second half of 2020, things look better. And when we talk about better, we mean
more balanced.
And that must mean demand. You expect demand to be, I think some of the numbers from the big three, well, they're all over 1 million.
Right.
And I think the EIA is 1.37 increase over 2019, and OPEC's the lowest at plus 1.08. So.
Right, and you have, in the second half, your demand increases seasonally. In the
Right.
first half, you lose some transport demand in the OECD. What could help them in the first half, obviously, is if the winter is, if we've got a very cold winter,
Right.
that would certainly help. That'll add, that could add a few 100,000 barrels a day, if not more, if it's a frigid winter. If it's a mild winter, that's definitely challenging. And yeah, that's still a factor. And of course, we have the IMO 2020 coming up, which we'll discuss. But I think seasonally demand goes up in the third and fourth quarter, and that will, that'll certainly help to balance it out in the second half. It's just getting through the first half.
Yeah, I think the IEA and the others are looking at something like 3.4, 3.5% growth worldwide. So that's, I think, where the IMF is, something around those numbers. And right now, with there was concern in 2019 that demand was, not really robust. And since then, or recently, we've seen some decent numbers out of China. Maybe they're turning around a little bit. And also we had, 3 cuts in U.S. interest rates. So, maybe this is maybe we're not going into a recession in the U.S. and the world, and maybe we're going to pick up growth a little bit. So,
the Chinese petroleum demand has actually been rip roaring.
yeah,
Right? It is very surprising. You think just the opposite, but demand has been really robust in China. Not so much in India, not so much here. I mean,
right.
demand in the U.S. has been, we're barely growing this year.
Right. And so for 2020, what are you seeing in China? Are they still looking at like 400,000 a year?
Yeah, I think 400. Lately they've been ripping like 600 to 700.
Yeah.
But I think 300 to 400. The IEH, and I know we discussed this, had an interesting analysis where they thought that the trade wars had cost global GDP, like I think it was 0.8%, and that translated to 400,000 barrels a day of demand growth, or of demand.
That was lost.
That was lost. Yeah.
Well, I was just telling, we were talking about this before, but, the oil world's turned upside down. We're in a week where OPEC ministers are talking about their policy, and the market's reacting to that a little bit, but the market's seems to be equally concerned about what comes out of the president's tweeting account in Washington, D.C. So it's kind of, if he keeps increasing tariffs, and that, dampens GDP worldwide, it certainly affects oil. And I think you see that oil prices show a positive correlation to the stock market. So, that's kind of they do correlate, not 90%, but it's somewhere anywhere between like 20 and 40 at times. So
right, and
there.
400,000 barrels a day is a big number. I don't think it's quite that big. I think it's probably 250 to 300, but nevertheless, if 400 is right, that's that's a big number relative to growth. If we're only growing 1. We could have grown 1.3, 1.4. Obviously, that's big relative to total demand of over 100 million. It's not
right.
It's not huge.
But we're talking marginal, and on the margin where the prices are determined, right?
Right.
That's the main thing here.
Right.
I just want to make a couple comments on the world of that I spend a lot of time in, and that's options, Andy. It's been the if you told me this, looking back on this year, if you told me that we'd have an attack on the Saudi oil installations, and that was not the high in volatility, I would say you were crazy. But that's exactly what happened. We had September 16th, the vol was 46%, and January 2nd was actually the high, 53%. And January 2nd, we tumbled. I think we made lows on December 24th of last year. So we were coming out of a bearish situation, which always gets vols pumped up. But still, it was surprising to see it not rally. The other thing that's been really sort of outstanding in the option world is that year-to-date volume is down almost 30%. So in November of this past month, 93,000 options traded on an average daily basis. Year ago, we had a big month. It was 278,000, and year-to-date's 126. So, we're going into an OPEC meeting, and we can't even generate option activity. We generate a little bit, but not a lot. So I think it's hedge fund stuff that's moved away. I think we've seen some money come out of that hedge fund world and the commodity trading advisor world. But I'm just, I've never seen it like this in a long time.
Well, the market, if you look at total inventories, global OECD inventories, we're in pretty, we're in average shape. We're like 1 day supply below the 5-year average. So, we're balanced to a little bit long. And,
yes.
You look at the price here, and we're right around where we've been we're average price for the year is right around here. So
yeah, and I've heard some of the banks say we're projected for the next year to stay right around here.
Yeah, you look at the numbers.
Yeah.
You look at like the Reuters survey. You look at the surveys, and we're $1 or $2 from here. Now, most of these surveys are always wrong. So, something unexpected could happen, or something geopolitical, which we haven't spoken about.
Well, that's right. Yeah.
With OPEC and non-OPEC producers, that there's still the Iranians. Well, we had just had an attack on one of Saudi lost 5.7 million barrels a day in September of production owing to an attack probably financed or taken part by the Iranians. And I'm sure that I'm not sure, but we haven't seen any military reaction yet.
That's a good point. I just along those lines, if we're going to have a surplus first half of the year, that would be a good time for the Saudis to replenish storage supplies,
right?
Or no?
Right.
So kind of we'll depending on how much of a surplus we see, we may not even feel it in the market as they fill up. I don't know.
Yeah, that's possible. And we also have demonstrations in Iran, Iraq, Libya just lost an oil field. Nigeria isn't particularly stable. So there's and Venezuelan production is not going up. That's for sure. And Iran is having some big financial problems, as written about today in the journal. So and as we always say in these things, Jim, it's we just named all that, and it's usually something else, right? That you're not expecting.
Of course, that's right. Yeah, I mentioned how option volume is quite low. However, the January implied vol is 35.3, Feb 31.8. So that's not, that's like average.
High.
It's high, but it's average vol if you go back long term. But it's we're going into an OPEC meeting, so
right.
So people aren't, even with these flat expected price movement, same price today is expected to be next year. We're not seeing people crush vol, is what I'm saying.
Right, they're not crushing vol, right? Because there's a lot of little fire. They have could be big fires.
Yeah,
all around the globe.
Yeah, imagine trying to sell an option selling strategy to your management after what happened this year. It's just it's really hard. I would presume it'd be hard to do that. So, okay, so let's start looking forward, Andy. there are a lot of things that could happen. We've got the U.S. People have talked about the U.S. Fracking to act like an option or to dampen volatility, because if price goes up, they produce more. Price goes down, they produce less. Why don't we talk? Why don't we talk about diesel for a few minutes? And what do you see as the prospects for?
Well, diesel is the big question. Is the big question mark. With the IMO 2020, which could increase diesel demand by as much as 1 million barrels a day. The numbers are all over the place for how things are going to fall out beginning in January 2020. I guess the question is, has the market already, have things been, have we prepared already? Are we well prepared? I think the IEA is saying, things look fairly well prepared for IMO 2020. There seems to be ample lower sulfur product right now in the global shipping ports. Here in the U.S., it's less of an issue because most of the shippers refuel abroad. But the EIA thinks that we're going to be producing a lot of diesel coming up. Some of their numbers are just out of control for how much diesel and how much crude runs we're going to crude runs. What the crude run number is going to be, I don't believe any of the. Personally, I don't believe any of the numbers. They think we're going to just produce diesel willy-nilly and export it, and I don't see that. The diesel cracks, meanwhile, have really come off here. Again, indicative that things are for now at least are okay, are ready to go for IMO 2020. Of course, manufacturing ism yesterday was horrendous. I think, what is it, the worst since that 2012, 2008. Yeah. So manufacturing is still problematic, and that is directly directly compares to for diesel use, for trucking and rail, etc. Now, inventories, though, the good news is inventories here are low, particularly in Pad 1. So we get any kind of spike, if we get a really cold winter, things can turn around quickly. However, again, the backwardation in the first 2 months has just collapsed in diesel. It was highly backwardated. Now it's slight backwardation, and gasoline, which that looks, the U.S. gasoline demand is completely plateaued. Pad 1 stocks are average, and and it's gone into a contango. Now, margins in Asia are crappy because of the high sulfur fuel oil has collapsed, not surprisingly. And there are new refineries coming on. So, some big ones in fourth quarter and into first quarter. So, unless diesel really somehow spikes, it's hard to see that margins are going to improve all that much. They may get worse, which is bearish. I'm clearly bearish for crude.
So if we're making more diesel, it's not at the expense of gasoline?
It could be at the expense of gasoline. Yeah, it could be, depending on what the crude run slate is.
Right.
There's a lot of variables, but it could be at the expense of gasoline. We'll see. The EIA thinks it will be. I don't know. I mean, oftentimes we say, oh, it's definitely, gasoline's going to get tight. I'm not sure, Jim.
Okay, so let's just talk about prices going forward. Do you agree with? I'm going with that consensus of 60. I think they're talking about $60 in Brent. What's your view? Let's just go a month to 6 months out. What are you thinking? And
I wish, Jim, I wish I could get really excited, about the market, but you look at where the fundamentals are, and unless OPEC affects a miracle cut here, which I don't see. I really don't see that happen, or demand really surges. It's hard to see sustained upside for, let's say, WTI, in the mid 60s, or Brent in the 70s. It's just hard to see that.
Right.
Or there's something, Straits of Hormuz, or some are blocked, or some geopolitical event. It's really hard to see sustained upside. Alternatively, on the downside, I think that we could maybe get down to the low 50s or 50 in WTI sometime in the first half, particularly if it's a balmy winter. So yeah, but below that, to get below that, we're probably going to have to see big U.S. production numbers, Jim, to get like way below 50, into the 40, low 40, 45ish.
Right.
I think we're going to have to start seeing in first half production numbers like 13.3, 13.4, something like that.
Right. And then I guess another somewhat unrelated question would be the pricing of the Aramco IPO, and I'm not talking about.
Well, it is related, because the Saudis clearly want, they want prices to remain high. I mean, they'd love Brent at 80. 80 is like their magic number.
Yeah, we all have a certain price in mind that we would like, but
what do you mean?
I would like the Giants to win a game too. So, do you think that changes Saudi's policy at all? Do you think once this thing is out there, or they continue to kind of keep these quotas going? And I guess my question is, would they do the old-fashioned sweating, where they just kind of say, you know what, we can't keep these frackers and other people back. We're going to lower prices now. Now that we have some money out of Saudi Aramco, we've raised all this money. We can let the market drop and kick out a lot of these inefficient producers, kind of like an old policies that they used to have.
It's always a possibility, that things change in the kingdom, and the MBS and his advisors decide to go scorched earth. I don't think that's going to happen. As I said, if they could just get to the second half in one piece, they'll do okay. But if they can't, maybe they will decide.
Yeah.
You know what? We want to shake out the frackers.
Yeah.
We want to encourage demand of petroleum. But I get the sense that they're looking. That they're not going to go that way.
Yeah.
I think MBS is a pretty forward-looking guy. And I think, I don't think they're going to go that way.
It's nice when you're raising money for an investment, and with friends and family, you can raise billions.
Right.
So, anything else, Andy, before we wrap this up?
No. I think we covered a lot, Jim. And
Yep. I was going to say, we try to put these out on a monthly basis. We missed our last month due to our schedule, our scheduling, and our next one. We tend to try to do them right after the EIA puts out its monthly oil report. Try to continue to do that. So look for us in January, to probably the second month, for our next podcast.
Last thing, if you want any more information about Commodity Research Group, you can certainly get a hold of me at Lebow, ALEBOW, at commodityresearchgroup.com, or check us out on our website.
Yes, and we also, in our consulting, we'll provide specific trading ideas depending on what what the situation is, but we just don't do that on a podcast, because we don't want to we don't know who's listening and whether or not they're suitable for who's listening. All right. So we'll see you next month.
Okay.
Sounds good, Andy.
All right.
Talk to you later.